All right, let's move right on then. And hospitality clearly has been the cynosure of all eyes, with domestic tourism making leaps and bounds. So, here to discuss that, as well as earnings, new signings of properties, international expansion forays, is none other than Patanjali Keswani, the Chairman Managing Director at Lemon Tree Hotels. Thank you so much for taking time out. Finally, we've managed to pin you down and get you on air. So good to have you. There's so much to discuss, but why don't we talk a little bit about the numbers and your, financials a little more in detail. Operational performance, that's been a little bit weak in the quarter gone by, at least. There was a higher renovation expense and the deflationary impact of Aurika Mumbai. So can we assume, Mr. Keswani, that the upcoming quarters, your margins will stabilize?
Good morning, Avan. Yes, you can absolutely assume it because, see, you open a very large hotel, which is roughly 13% of the total owned inventory. Naturally, when you open it in the first, initial period, it is not stable. So it has got expenses, but it does not have revenue. Revenue catches up. And unlike, say, an aircraft, a hotel doesn't fill up instantly. It normally takes, depending on the market, the size of the inventory, it takes a certain amount of time before it hits cash break even. And interestingly, our hotel hit cash break even in the first quarter, but there was a big impact of interest and depreciation, roughly 20 crores every quarter. And that's what really affected from a P&L perspective, it affected our occupancy and our EBITDA margins. But that is not going to be the case from this quarter onwards.
You said that it takes time for a property to kind of come up the curve. What's the status with Aurika in terms of occupancy and the revenue contribution? And overall for the business, what kind of occupancy levels are you envisaging for the next 6 to 9 months?
Or in general, or are we talking specific? Well, overall, I think occupancies are picking up. See, we are in the midst of what I would call is a structural change in hotel consumption. Over the next 3 years, I expect a very large number of customers, a very large number of people in the Indian population to start, as their income improves and increases with the increase in the GDP in our country, then very large numbers of people move into what we call the consuming population for hotel rooms. So I'll give you an example. The total number of consumers of hotel rooms in India would be less than 5 million households. Literally, branded hotel rooms. Now, that is likely to grow when the GDP grows by about 40% in the next, say, 5 years. This consuming population will grow from 5 million to, say, 30 million. Okay, and that is the real structural change in consumption that we are looking forward to. So it's not cyclical. I hear everybody, analysts, commentators talk about cyclicality. Yes, of course, there is cyclicality in this business, but what I think people are missing out on is the structural shift in demand that will start playing out. And that is why I suspect that the next certainly the next 5 years, there will be literally every half year compared to the previous half year, because we are cyclical in H1 and H2, there will be this big increase in consumers, domestic consumers for hotel rooms. So yes, this following half year should be better than the previous year, and this will continue indefinitely.
Mr. Keswani, yes, there is a structural change. Consumers will increase. But, specifically, I think I just want to put down a point in terms of Aurika. What is it in terms of the occupancy rate that one could expect? You're saying better, but what would that percent be? What would that rate be?
So in the first quarter, we did, when we opened it, we did between 35 and 40%. This quarter, we will do, I think, over 60%. And when it stabilizes, because it is the largest hotel in India, so it's nearly 700 rooms, so it takes a little more time to stabilize. I expect that, for example, in FY26, it will do over 80%, because that's what our other hotels in Bombay are doing. We have 3 other hotels. And it will cross 300 crores in revenue and about 200 crores of EBITDA.
Now, given that, you have your focus now is going to be on strengthening the balance sheet and reducing the overall debt, can you take us through what exactly those metrics are going to be like?
Yeah, so Avan, we basically deployed or operationalized about 3,000 crores of investment 1 year before COVID and now roughly 2 years after COVID. So these were the new hotels that we opened, which obviously did not earn the kind of money, returns that they would once it stabilized. So in this process, our total debt peaked at about, will peak. I mean, it is currently at peak. It's about 1,900 to 1,950 crores. And if you take our debt, I really look at debt to EBITDA. Our debt to EBITDA was about 3.6, 3.7. Now is. And next year it will be under 2.5. And finally, debt to EBITDA in the third year will be in FY26 will be under 1.5. So effectively, what I'm saying is that by FY27 or latest FY28, we will be debt free. So we will obviously generate enough cash to write off this 2,000 crores of debt in the next 4 years
Okay, and
at most.
okay, point taken. But I also wanted your sense regarding the business travel part of things, because what we hear from IT companies and a lot of other companies is that there is a bit of a challenge when it comes to the discretionary spends and travel spends, etc. Is that impacting operations in your business travel regions?
Yes, it is because uh, in three cities we have large inventories which are where the IT sector is a significant customer for us. So, like in Bangalore, in Whitefield, we have two hotels which have about, I think, 350 rooms. In Pune, I think we have four hotels or three hotels which have about 400 rooms. And in Hyderabad, we have, I think, about four hotels which have about 700 rooms. So these are the three markets where IT is a significant contributor to our hotel rooms. What I find interestingly is that in Hyderabad, it has not, in spite of the fact that one segment has reduced, there have been other segments that have more than compensated. In Pune, somewhat similar, but Bangalore, where we have also in Electronic City side, we have another 300 plus rooms. Those markets have not yet recovered. But I am told by my people in sales that this will not be the case from this coming year onward. So it has been like a 1 year impact.
Mr. Keswani, also, what is the shift that is coming in? Earlier, you were on that asset-heavy model. Now you're focusing more in terms of management contracts as well. So when do you expect that to hit that 70% inventory for management contracts? How will that actually translate into your earnings growth?
Oh, it'll be a significant contributor. So two metrics you should keep in mind that for every, so being asset heavy means you take the financial risk and obviously you get the upside. But when you manage hotels, typically for every 6 or 7 hotels you manage, the fees that you get are equivalent to one hotel. So think of it this way. If I manage 6 hotels, it is like owning one hotel with no risk because that is the percentage of fees I get, which is typically 1/6 of the EBITDA. Now, if I look from what we have publicly stated, we currently have about 10,000, 100 hotels operational with about 10,000 rooms. 6,000 rooms are owned by us and 4,000 rooms are managed. So those 4,000 rooms really is like owning, say, 700 rooms. So really, that is how you should look at it. Now, what I said was that we have about, I think, about nearly 4,000 rooms which are signed up for management, but those hotels are not yet ready. So they will get ready. They will be added into our operational inventory in the next 2 to 3 years. Now, every quarter, we typically sign, anywhere from 500 to 1,000 rooms. So if I just go by those trends, my expectation is that in the next 3.5 years, we should hit 20,000 rooms, of which 6,000 will continue to be owned by us, and the remaining 14 will be managed. Now, those 14,000 that are managed will give us earnings, which are the equivalent of, say, 1/6, which is like 2,500 rooms. So really, at that point, roughly, let me put it this way, roughly 2/3 of my EBITDA will then be owned hotels and 1/3 of the EBITDA will be from the managed portfolio. Although in terms of control, I mean, in terms of inventory, it will be the reverse. So we will have two-thirds managed inventory, one-third owned, but the EBITDA contributions will be exactly the opposite.
Okay, got to know. So that'll really help overall boosting your numbers. And you're also looking to operate and manage hotels in New York, London, Singapore, Hong Kong. What are the international plans?
So really, if you look at India pre-COVID, about 26 million Indians traveled overseas. And this is a number which I expect will continue to grow with, as I said earlier, the growth in GDP per household at the consuming levels, which is typically I see three segments, which segments earn say $10,000 to $35,000 per household, which segments earn 35 to 100 and over $100,000. So these are really three distinct categories where there is aspiration to consume branded hotel rooms. So the same population also travels abroad. So my view is very simple. Wherever Indian consumers of hotel rooms travel internationally in significant numbers, obviously we would like to have a brand presence there. But we don't intend to deploy capital. We intend to simply manage hotels in those cities and countries. So right now, we are going to be opening a very large number of hotels in Nepal in the next 2 years. I think 4 or 5. Okay. We have a hotel in Dubai. We have a hotel now in Bhutan. And my expectation is over the next 3 to 4 years, some of the cities you mentioned, we will be managing hotels. We will flag hotels in those cities.
Keeping a close watch on that, Mr. Keswani, but that is international. But I just want to understand one thing in domestic travel that's really picked up pace is, pilgrim tourism or religious tourism that we say. Anything specific that you would look at in terms of either management contract side or, opening up hotels in that front over there in those cities?
So we are present in multiple locations where pilgrimages occur. But here is what I was trying to understand what is this segment and what is the spending capacity of this segment. So I read this very interesting article that last year, the average spend per pilgrim and family in religious destinations was only 2,700 rupees a day, including stay, meals, and travel. So that is not a price point where I suspect branded hotels can make money, because even the cheapest branded hotel would be in the mid 3,000s. So my view is pilgrimages, and therefore the associated tourism will be a very large sector, but it will still take some time for consumption expenditure to actually reach a point where there will be demand for, say, 3 or 4 or 5-star hotels. Until that happens, I would prefer to wait and watch. And when I'm pretty sure that there is such demand, then we may look at expanding in that segment. So if somebody comes to us, and there are people who have come to us, obviously, to manage their hotels, of course, we are absolutely more than willing. But the price point and our ability to deliver results is something that I think will still take a little time.
Okay, Mr. Keswani, thank you so much for joining in with us, giving us your time on ET Now. Hope to see you more often on the channel as well. Thank you so much for that. That's the management of Lemon Tree Hotels joining in with us, talking about how consumers are changing in terms of travel, tourism, as well as the boost that we are seeing in tourism as well.